Hey everyone, welcome back to the channel. I would like to take a second and ask if you enjoy stock analysis content, then please subscribe as it helps keep this content free. Also, turn on the notifications button as we are releasing new content every day. Thanks, and now onto the video. Hey everyone, this is Andrew and welcome back to the channel. Today we will be analyzing a stock that should be avoided at all costs in 2026. The stock we will be talking about today is Roblox. Roblox has become one of the most recognized names in online gaming and virtual experiences, offering a platform where users can create, share, and play games in an immersive environment. Its appeal spans across demographics, particularly younger audiences, and its ecosystem of user-generated content has fueled impressive growth over the past few years. However, as we look ahead to 2026, there are compelling reasons why investors should exercise caution and consider avoiding Roblox stock during this period. While the company has built a strong brand and continues to innovate, several structural, regulatory, and financial challenges could weigh heavily on its performance and share price. One of the most significant headwinds for Roblox in 2026 is the introduction of new mandatory age verification rules. These regulations will require chat users to verify their age using a government-issued ID. While the intent behind these rules is to enhance safety and compliance, the practical implications could be disruptive. Roblox's success has largely been driven by its social and interactive features, particularly chat functionality, which fosters community engagement and retention. Introducing stringent verification requirements could create friction for users, especially younger players who may not have easy access to government IDs. This could lead to a decline in user engagement, slower onboarding for new players, and potential backlash from the community. For a platform that thrives on network effects, any reduction in active participation could have cascading effects on monetization and growth. Another critical concern is Roblox's valuation. The company's share price already reflects strong growth expectations, which means the market is pricing in continued expansion and operational success. If these expectations fail to materialize, whether due to regulatory hurdles, macroeconomic pressures, or competitive dynamics, the stock could face significant downward pressure. Growth stocks are particularly vulnerable when sentiment shifts, and Roblox's premium valuation leaves little room for error. This risk is amplified by recent price action. As we approach the end of the year, Roblox has experienced a sharp decline, losing several dollars per share in just the last 2 months after hitting a new high of $138 per share earlier in the year. Such volatility underscores the fragility of investor confidence and the potential for further corrections if fundamentals disappoint. Profitability remains another sticking point. Roblox is not profitable on an earnings per share (EPS) basis and is not forecasting profitability in 2026. For many investors, especially in a higher interest rate environment, profitability is a key metric. Companies that fail to deliver positive EPS often struggle to attract long-term institutional support, as they are perceived as riskier and more speculative. While Roblox has demonstrated the ability to generate free cash flow, a positive sign for operational sustainability, the lack of earnings per share will likely weigh on sentiment and limit upside potential. Investors increasingly favor companies that can balance growth with bottom-line performance, and Roblox's inability to achieve this balance could be a major deterrent. Valuation metrics further reinforce the cautionary stance. Roblox currently trades at a price-to-sales ratio of 13, which is elevated compared to its historical range of 9 to 10 over the past 3 years. This premium suggests that the market continues to assign a high-growth multiple despite mounting challenges. If revenue growth slows or margins compress, This multiple could contract significantly, leading to sharp declines in share price. In other words, Roblox is priced for perfection, and any deviation from optimistic forecasts could trigger a painful re-rating. While Roblox continues to grow and generate free cash flow, an important factor for long-term viability, there are macroeconomic considerations that cannot be ignored. As the economy weakens and discretionary spending comes under pressure, consumers may begin to reassess where they allocate their money. Virtual gaming and in-platform purchases, while popular, are not essential expenditures. If households tighten budgets, Roblox could see a slowdown in bookings and engagement, further straining its growth narrative. In such a scenario, it is plausible that Roblox's stock could decline by another 30 to 40%, particularly if investor sentiment shifts toward more defensive or value-oriented sectors. It is important to note that avoiding Roblox in 2026 does not equate to dismissing the company's long-term prospects. Roblox has built a robust ecosystem and remains a leader in user-generated gaming content. Its brand strength, technological capabilities, and loyal user base position it well for continued relevance in the digital entertainment space. However, from an investment standpoint, the current valuation and near-term challenges make the risk-reward profile unattractive. The stock appears slightly overpriced given its lack of profitability, regulatory headwinds, and vulnerability to macroeconomic trends. For investors seeking exposure to Roblox, patience may be the best strategy. If the share price falls back into the $40 to $50 range, a level that would represent a more reasonable valuation relative to fundamentals, that could present an opportunity to initiate a position, assuming the company's financials and outlook remain stable. In conclusion, Roblox is a fascinating company with a compelling product and strong brand equity, but 2026 may not be the right time to invest. Mandatory age verification rules could dampen user engagement, while lofty growth expectations embedded in the share price create significant downside risk if performance falters. The recent share price decline, lack of earnings profitability, elevated price to sales ratio, and potential macroeconomic headwinds further strengthen the case for caution. While Roblox will likely continue to succeed as a business, its stock may face considerable pressure in the coming year. Investors should monitor developments closely and wait for a more attractive entry point before considering exposure to this high-profile gaming platform.